All right. Welcome back to our weekly. So everyone's talking about fear, but the market isn't breaking. Stocks are near record highs. Bitcoin is holding firm, and our new MarketVector Crypto Heat Index just dropped into deep value territory. So in this week's video, I'll break down why fear remains high, even as risk assets hold, what this earnings season is revealing about the real economy, and how market leadership is broadening beyond mega caps. And I think crypto might be quietly entering an accumulation phase. So let's get into it. So this is fear without a breakdown. Let's start with the big picture. Fear and Greed Index from CNN is stuck in deep fear at 28, yet the S&P, we have it here, is near or at all-time highs and climbing. And that's the hallmark of a market climbing a wall of worry, right? The macro data still point to resilience, by the way. And here is a US bank headlines because everybody is worried about banks and private credit. So US banks report steady consumer spending, healthy credit quality, and even a pickup in deal flow. Think of it. And that's not what you see before a recession. And yes, it's uncomfortable, but this is the type of environment. High fear, strong data often produces some of the best forward returns. Everyone feels we're in a bubble, but no one's positioned for it. And even here, high yield credit spreads. Is that a worry? No. We had a short spike due to this regional bank thing with private credits and this fraud, but it's very decentralized and not a systemic risk. Yeah? So that doesn't sound like a systemic credit risk here. So no one's is positioned for a rally. Everybody hates it. And we still have seasonality here. So the best 3-month period, November to January, is starting in October. So that's the optimal entry date for Q4 to Q1 forward returns. And we have a saying, buy in October, get sober, for a reason. And also here, that's another example. It's mind-boggling. I mean, we have all-time highs globally. That was the Nasdaq dip here. And people are getting bearish after a dip, which is normal human behavior. Unfortunately, we are not made for investing. I have to say that. Now, under the surface, we are seeing rotation, not exhaustion. So high beta stocks, that's this chart here, are leading again. Yeah, so they are in a strong uptrend. Yeah, so that's the high beta sector versus the low vol sector, and this ratio is just climbing higher, and that's a clear signal of improving or strong risk appetite here. Also, where do we have bonds? It seems here that bonds represented by the IEF ETF are showing early signs of rounding bottom here and approaching resistance. So a breakout here would confirm that yields are easing. Keep in mind, easing in a strong economy and also supportive for rate sensitive assets. And you already see that, for example, in sectors like biotech. Meanwhile, gold, everybody was long gold. Gold has lost its parabolic shine. So after a vertical rally, it's finally correcting. And I think it's a healthy reset after months of speculative froth. I still think long-term it's valid to be in gold, but it's always a question of how high the price is, about valuation. So liquidity is rotating, not leaving the system, and we might have a good chance that this liquidity might also flow to Bitcoin. Now, to earnings. Look at this. That's the real pulse of the economy. S&P 500 companies are delivering the third highest earnings per share beat rate and the highest revenue beat rate at this stage of the earnings season for any quarter since at least 2001, right? So that's extraordinary resilience given where we are in the cycle. And it confirms what price action is already suggesting. Corporate fundamentals remain robust, profit margins are stabilizing, and demand has not cracked. So in short, this isn't a top, it's a normalization phase within an ongoing expansion. I know people have a hard time to believe it, but that's a fact. Bitcoin. We are in a distribution phase or consolidation phase. So the title here is for this video is Fear Without a Breakdown. So Bitcoin continues to hold its range around this 108 level. We are now a little bit higher, but you see how important this level is. And I would say as long as we are above the 100 level in 98 to 100, it's still a bull market. So it's important that we climb now above the 115 level. Let's see. But I would say structurally, this is a consolidation, not a collapse. The coin 50, I always like that as a proxy for the market, remains below the 500 level. So that's the line to watch here for confirmation of a trend reversal for the broader crypto market. And another very interesting chart here, the institutional allocation remains minimal. So the BofA fund manager survey shows an average crypto weighting of just 0.04%. So the masses are still out. That's a perfect contrarian setup. And I think that might change when we get the Clarity Act, when the large pools of asset manager can finally entry here. Also, Bitcoin dominance. Here we have this huge wick to the upside there. That was the flash crash, classic shooting star. And that to me is more like a bear flag, right? So I still think that Bitcoin dominance should go lower. And that would speak for still the altcoin rally we are all waiting for. I mean, so far it was a good market. Problem is that people are invested in the wrong tokens. So here we have our 3 different indexes: large cap, mid cap, small cap. So that's the top 20 tokens. That's the middle rank 21 to 50, and that's the bottom 50 token of a top 100 universe. And what you see is why in the 21 cycle, that smaller coins outperformed and we had a super strong rally. Now it's just about being in the more liquid large cap token. And if you just have a bunch of super small altcoins, that's not your market. Yeah, let's see. I think in the final altcoin rally, there could be life for small caps as well. But so far, it's a bifurcated market. And last but not least, that's our heat index, our new one. It's a sentiment indicator, which indicates if the market is too hot or too cold, meaning in this desperate mode. So here you see we're at 20%. We're definitely in the more undervalued zone. And so I think there is still room left for a rally, but we have to watch the charts. And I think as the risk market overall is so strong, especially the equity markets, but also commodities. Crypto should follow soon. So while the mood is fearful, I think the data say otherwise. Markets are stabilizing, not cracking. Equities are broadening. Credit is contained. And digital assets are quietly resetting for the next expansion. So I hope you liked the video. We keep you updated next week. As always, smash the like button, subscribe, please, and thank you for watching.